Dividend investing can be incredibly powerful. You set up a retirement income for life. You never have to sell anything or worry about share prices. And unlike an annuity, you can pass on your portfolio to your loved ones. But there are some big risks, and if you get it wrong, you could end up with regrets. Let me explain some dividend investing strategies for retirement. First solution for retirement income is a high yield ETF. The ETF IUKD represents the 50 highest dividend payers in the FTSE 350. And there are some awesome dividend yields on offer, such as 10% from Phoenix Group and M&G. With IUKD, this high dividend ETF automatically selects the best dividend payers and ultimately deselects those that suspend or massively cut their dividends. For a fee of 0.4%, you can sit back and watch the cash come rolling in. The current dividend yield is 6%, so who needs the 4% rule? Is this passive income at its best? What could possibly go wrong? Well, it turns out quite a lot, because first of all, dividend per share peaked in 2008, 15 years ago. The ETF pays out dividends according to what it receives from the companies it holds shares in. So if you bought the fund in 2008, your income halved in 2009 due to the ETF being overweight in banks during the global financial crisis. The ETF doesn't rebalance quickly enough, so you can end up sitting on dud companies for longer than you would like. With this dividend ETF, you'd have had to put up with very variable income. Income from the fund is still below what it was in 2018, and there has been considerable inflation in recent years, which has eroded the purchasing power of the income you would have received if you had have relied on this for retirement. The share price of IUKD has seen better days. This would be less of a concern if the dividends were more reliable. The price decline also means that the dividend yield is a bit of a misnomer. If dividends fall and the share price fall, then the dividend yield still looks reasonable when actually the total income received is considerably lower. For this reason, it is better to also look at yield on original cost price, which in this case would be a lot lower than the quoted dividend yield, and this would give you a better picture of what's really going on. To get back to the dividend per share that matches 2008, we would need a hefty increase in the dividend per share. This is one ETF where backtesting the strategy is useful, and when timing can be employed to your advantage, as there is a highly cyclical nature to this product. The sector split of IUKD is also quite narrow. There's a heavy reliance on financials and banks, and even within consumer staples, there's a lot of things like tobacco, which is in long-term decline. There's an absence of technology, and there's hardly any healthcare. So by employing this dividend strategy, you're really putting yourself in quite an odd sector mix that might not be advantageous in the long term. So here are all the potential problems of a high yield ETF. You can have unpredictable payouts that we've seen. You can have dividend payouts that are funded from debt, so it's just increasing its borrowing to pay you money, and this is not sustainable in the long term. High payout of dividends can limit future growth because there can be less opportunities for the company to invest in new products or breaking new countries, while its competitors that pay lower dividends could be investing heavily. And finally, a high dividend yield could be just a symptom of a decline in the share price rather than any specific characteristics of the company itself. Another solution could be to invest in individual companies, but the problem with this is that it takes a very long time to properly research companies and put together a portfolio where you have real confidence in the holdings. And you need to look at a whole load of ratios, things like dividend cover, dividend payout ratio, and look at those in terms of what the profit and loss account is saying, but also what the cash flow statement is saying. You'll look at things like the indebtedness of the business, and when you read the report and accounts, you can find there's maybe too much marketing puff that really distracts you from the underlying awful business that you might be about to invest in. So one solution to that might be to use some kind of package like SharePad that might enable you to cut through the data very quickly, but this can be quite expensive with charges of maybe £40 a month. There are dozens of YouTube channels that talk about, hey, check out my dividend income this month, but I would really treat these with massive caution. I don't think they're doing the research properly. And one of the things they never do is tell you when to sell. So here is Direct Line that used to pay very high dividends, and early in 2023 it announced it was suspending the dividend altogether and the share price collapsed. So the issue here was, well, when would I sell this if I held it in my portfolio? And I find that generally these other YouTubers just don't tell you, and so you could be stuck with a load of duds in your portfolio wondering what to do. And here's another dud company, Vodafone. This company borrows money to pay its shareholders a dividend, and this is at the expense of investing in innovative services. For example, I think that Vodafone could have come up with Vodafone Web Services rather than the reality is that it's actually a customer of Amazon Web Services. So Vodafone could have been such a better company if it had only cut back its dividend and invested in true growth areas. People who invest in individual companies and trade frequently often use cut price brokers such as free trade, but what they don't understand is that these cut price brokers often have slightly dodgy financials. Here are the free trade reporting accounts that I got from Companies House, and it shows the company made a loss of nearly £40 million in 2022. A third solution would be to invest in an investment trust that has reached the status of dividend hero, meaning it's increased its dividends for 20 years or more. Because investment trusts have reserves, they are able to hold back income that they receive from companies, and then they can tap into these reserves during times of economic stress. For this reason, they're a much more reliable dividend payer than an ETF. However, the dividend growth of these dividend heroes can be quite low, possibly below the rate of inflation, particularly if the dividend yield is already quite high and into the 4 to 5% range. This chart looks at the 10-year performance of IUKD versus a dividend hero equivalent, in this case Merchants Trust. And we can clearly see that Merchants Trust, particularly in recent years, has been a significant winner. Here's a list of some of the dividend heroes. You can get the full list from the Association of Investment Companies website, and I've done videos on this in the past, and I'll put a link in the description. So Americans know how to do dividends. Here's a list of US companies that have increased their dividend for 50 years or more, and there's dozens of them across different sectors. In the FTSE 100, no company has increased its dividend for more than 40 years in succession. But the irony is that most dividend investors are actually underweight the US, where there's rich pickings for decent dividend companies. I do get a bit confused by people that solely want to live off dividends in retirement, particularly if they retire early. The reason for this is that when they hit 67, if there's two of them with a full state pension, they're going to get an extra £21,000 before tax coming in. So they could end up with quite a back-end weighted income. And what they really want to do is have some money, maybe in something like an ISA, that they can sell down in the years leading up to receipt of a state pension. And possibly what they might want in this ISA is something that more matches the global stock market and has a little bit more growth orientation about it. I think this shows that you need a decent financial plan in retirement that models your wealth over time and all the sources of income that are coming in. And if this interests you, check out my website. To find a decent US income fund, I used the website Pick a Fund, and I searched on 5-year total returns, and I found a couple of ETFs at the top of the pile that focus on quality dividend growth. The ETFs I've just highlighted are accumulating. that means that they invest in themselves, which is great if they produce decent returns. A high dividend company, on the other hand, eats itself. It chops itself up and gives away the pieces to the investors until there's hardly anything left, and it goes bankrupt like Woolworths or Carillion. Here's the wisdom tree dividend growth offering compared to the FTSE 100, and over 5 years it's pretty much neck and neck, but the dividend growth fund had much lower volatility, and for that reason it might be more preferential for you to have in retirement, as it doesn't invest in companies that pay no dividend and are quite difficult to value, and it also doesn't invest in companies that pay too much in dividends and might be sacrificing the quality of the company just to pay out a dividend. So dividends aren't the sole source of income in retirement, because you also got things like the state pension, but dividends are a filter to stop you buying junk and then having these companies crash back down to reality. The S&P 500 had a lost decade between 2001 and 2011, and if you don't buy speculative stuff in the first place, then things won't be this bad for you, and so potentially a portfolio with a dividend tilt could be worthwhile in retirement. To illustrate a potential solution, what we have here is a dividend hero that's paying out dividends consistently, reliably, and ideally a portfolio of these companies so that you're diversified. And then we have something like a quality dividend ETF that we're prepared to sell down and exhaust when our state pension kicks in. And this way we've got quite a decent portfolio, and we've got a mixture of potential growth and quality companies as well as income. If you want someone to act as a sounding board to help you further develop your portfolio, then check out my website.